Hello and welcome back. And if this is your first time here, I am Dr. Stock, Doctor of Education, and well, welcome to the channel. I do want to talk in this video about the Fed and their decision to pause the rate hikes for the month of June, what I think is going to happen going forward from here. I also want to take a look at the summary of economic projections that they put out there and add some commentary along with what I think the Fed is going for. And also, I want to show you the spreadsheet that I have for GDP based on what the summary of economic projections has. And then finally, we'll take a look at the markets and talk about the Nasdaq, specifically the Qs, which tracks the Nasdaq 100, and then also the S&P 500, and just where I think exactly those markets are going to go as a result of what's currently happening in the world around us right now and with the economy, with the financial markets. So with that said, I do want to get right into it. By the way, I am using Moomoo in this video, and there is an offer if you want to check it out. You can get up to 17 free stocks by using the link that is down in the description. So the CME Fed Watch tool for the month of July is what we're looking at. Right now, we know that they paused in June. July, they're still saying nothing changed since the Fed came out. There's still about 2/3 of a chance that we get a rate hike in July, according to what we have with the CME Fed Watch tool. There's about 1/3 of the chance, a little bit better than 1/3 of a chance that we get a pause in the month of July. And honestly, I'm just not buying it. I really do think that the Fed has paused in June, and I think we're getting further data that confirms that it's okay to go ahead and pause in July as well. And I think that the Fed knows it. And I think that we see that between what Jerome Powell said when he pointed to the summary of economic projections that we get. So let me bring that up so we can talk about it. And I think the really key thing to hone in on here is the federal funds rate that we have of 5.6, up from the 5.1 for the target rate for 2023 is what we're looking at right here when we look at this. So the reason that I think that they put it at 5.6 isn't because they intend to hike rates. I think that it's because they more intend just to allow themselves wiggle room so they can continue to posture saying that they're going to possibly raise rates in the future if necessary. And I think that that is the entire thing. I think that this is the pause that we see throughout the rest of 2023. Now, back to the Fed Watch tool for a moment, because when exactly are we going to see any sort of cut to the rate? Well, I'll tell you, by December's meeting, right now, the bond market is saying we're still going to be between 5 and 5.25, which means that there is some sort of cut that's supposed to happen between what's most expected in July of a 25 BP hike, followed to what we get in December for it being 5 to 5.25%. So then when we go out to January, we still have the most likely, and I'll read this all for you just in case you can't see it, the highest bar that you have here, a little over 40%, still holding steady. And then when we finally go to the March meeting that we get, finally we drop down to 4.75, 4.75 to 5% for the federal funds rate. And then you can keep on clicking through. By the way, if you just search up in Google CME Fed Watch tool, you can pull this up for yourself. You can click around, you can play around, and they have tabs over here that you can use, and there's more data down below that you can also check out and, kind of play around with those numbers and see what you think. So for the change in GDP, I'll get further into that in the spreadsheet that I have. Went from 0.4% in March up to 1% that we have for GDP. So that means that they are acknowledging the further strength that we see from the consumer and from the economy. And well, that responded. And even if you scroll all the way across and you look at the range that was given, it went from -0.2 as the low end up to 1.3. Now the low end is 0.5. So there's not a single person from the Fed that thinks that by Q4 that we're going to be lower than what we were in Q4 of 2022 as that comes out. So that we end the year somewhere positive, which means maybe slow growth, but we still get growth out of it, which means that as of right now, the Fed is not seeing a recession in 2023. They do see a softening in unemployment because as of right now, it is 3.7, and it did tick up a little bit. And you can check that if you go to the employment situation. It's right here. This is from BLS.gov. You can get the news release itself. And this came out on Friday, June the 2nd, when we look at that one. Unemployment rate went from 4.5% when I believe they were still talking about possible recession, and now down to 4.1. So they are expecting still the tighter labor market, but with some softening from where it was at. So PCE inflation easing for us just a little bit. They still think it is holding higher for longer, and they keep on Jerome Powell keeps on reiterating that. So that's what we see in the summary of economic projections. I don't think that there's a whole lot more to glean from that for right now. So let me go from there over to what we have in the spreadsheet for Microsoft Excel. So let me pop that up there for you. I'll explain some things. Really, the second estimate that we have for Q1 GDP coming in at what equates to on a quarter-over-quarter basis of 0.3%. So mind you, this is an annualized number. So if you take this and you multiply by 4, and this isn't a perfect value here, it really comes out to about 1.3%, I think, when you annualize it throughout the year of 2023. And that is a perfectly normal thing to do. And you can just see what happens if we end up at the summary of economic projections at that median of 1%. You can see we get slow growth, but we still get growth, something that equates to, when you annualize any of these numbers here, somewhere close to that 0.8 number, which still comes out close to that 1% that we would have for GDP, according to the summary of economic projections that I have here. Even if we went the low estimate, we have slow growth, but we have growth showing all throughout, and that's assuming it's even. If we do ever see recession, it does not happen evenly. So that's something to pay attention to. That does happen usually pretty suddenly at first, and then continues to decline, and then slowly builds back up from there. So that's what we're seeing from that. And then if we end up at the summary of economic projections high estimate at the high end of the range, you can see we actually get some modest growth here. That any one of these numbers, if you annualize them, still comes out right around that 2% mark that we have. That's what I have for Excel for you, and I did say that I'd be showing Moo in this video. So we'll take a look at the markets. Actually, you can see the last thing I was looking at here, I believe, was my friend Tesla. Just that one, just looking to see, there's a lot of talk right now, will we hit 300, or are we going to soften for right now? This video is not about Tesla. I will say that I expect a little bit of softness, that we see probably 230 again before we see 300. Still bullish on Tesla, still an investor in Tesla. I just don't know that we have the sort of momentum going into this that's going to surge us up to 300. Now, mind you, we could have some awesome news come out about Tesla. We could have a continued surge in the markets, which again, I'll get to the markets in a second. But like I said, not a video on Tesla. We can cover that more in a different video. Let's go over to the Nasdaq. So with the Nasdaq, we are chasing down this high that we had back on March the 29th, 2022 of almost $369 per share for the Qs, which tracks the Nasdaq 100. And you can see the sort of recovery that we've made since then. So just a beautiful looking chart. I do want to point out that we have this concave up, sort of this cup looking feature that we have here versus something that would be concave down, which would be this shape that you see here. That would be sort of that umbrella. So when we look at that, this thing is looking almost like it's going parabolic over time, that we start to see that upward movement. It did have a little bit of rest in it, and then we just continued upward from there. We are solidly sitting above 50 on the RSI, and just compare that just for a moment, because I know I showed this in my other videos, but I want people to see it. When we had this big sell-off, this extended sell-off through 2022, the RSI had its moments where it peaked up above 50 and then spent most of its time back down below 50. So we can see that sort of momentum, and we can read into it that what we've seen since then is mostly above 50, some peaks above 70 for overbought, some softness as it corrects itself a little bit, and if it does dip below 50, it's momentary before surging back up again. So those could be signals for us for what to expect from this. I do not believe, my goodness, Dr. Stock. There we go. Let's also pop that out for you so it doesn't take up as much room. I don't believe that this run that we're on right now, this path, is one that's going to be sustainable for a long period of time in order to keep just up and up and up and sideways, or soften a little bit, drop a little bit, and then back up again. I think that would be something that could be a little bit more inspiring, give people a few more buying opportunities. And big tech, it's not really budging too much right now, and that's definitely propping up the market, especially as per the Qs with the Nasdaq 100 that we see. And I do want to say that I fully expect there to be a pause in July. I think the economic reports that will come out between now and the next Fed meeting, which I believe July 26th is when that date is, that we get the next rate hike decision when July happens, that there's just going to be a pause for us. And I think that switch, like even if we see a little bit of softness in the market, in the Qs, in the SPY, whatever between now and then, I think that's going to be the thing that would allow us to recover from that softness and rally on, maybe possibly even try out some of these overall highs that we saw before. And that would be incredible from where we stand right now, because that would still be about another 10% bump upward. So let's go to the SPY here. All right, so tracking the S&P 500, we look at the SPY, you can see pretty much the same action that we have, gapping up well above the 50-day, which is above the 200-day, looking very bullish here as well. So this one, again, we're getting near those areas of resistance where it doesn't mean that we're going to fail to break it overall. It does mean that given the run that we've been on, that we might be able to squeak out a few more percentage points. But I do think that there's going to be a little bit of a pullback in the near term that we have for the SPY. And like I said, when we see that flip-flop that I expect to happen for July, for the rate hikes, for those rate hikes to go from, hey, we're supposed to get another 25 BP hike, to the bond market being like, well, you know what? No, it's more likely that the Fed's going to pause here. I do think that the reports are going to continue to show us that inflation is moderating, that we're experiencing significant deflation. And I really think that July CPI release that we get for June is going to be a very positive catalyst for us. And also PCE coming at the end of June for May is also going to be very good for us as well. And I know that whole month thing is sort of confusing. All right, so let me wrap this thing up. The Fed paused in June. I think they're done. I think July is going to be a pause. I think the market is going to love it when they realize it. I'm hoping that there's a little bit of a pullback prior to that realization, because I think that'll really amp up the response to it. And maybe it's enough of a catalyst that allows us to push onto those new highs. We do need to keep in mind that we do have Q2 earnings starting in July. So that's also something that we're absolutely going to want to watch out for, to see what those next catalysts are with the corporate earnings, because that's going to tell us a lot more about direction, and hopefully we get some decent guidance coming out of that as well. I think there is a time that we might pull back in the markets, although I don't think, given the momentum that we currently have, I don't think that it's in the near term where we see any sort of major correction really to either side. So we're going to have to keep an eye on that, and I can only speak really for the near term right now, where I do think that even though we might get a little bit of a pullback, a little bit of some softness, I still think overall we're going to have continued strength for a little while longer yet. So we'll just enjoy the ride while we have it, and we'll keep on looking for those opportunities as they arise. And guys, do me a favor. Before I wrap things up here, don't forget about that offer for Moo down in the description, 17 free stocks. All you got to do is deposit $100 or more. When you do $100, you get 5 free stocks, $100 cash reward, and then 1 free share of C3 AI. So $100 cash reward aside, which is already a 100% increase on your initial investment, but you also get another $40 share on top of it. It's pretty incredible to me. And then $1,000 and $5,000 also comes in pretty sweet. 16 shares apiece, plus for $5,000 you get that 17th free stock that's either a share of Tesla or Google, guaranteed, along with still the $100 cash reward to boot. So it really is an incredible offer that you have. And then also down in the description is also my link for the Patreon. If you like my commentary, I'd like to hear more of it, please click on that, sign up, join me and my community members over my private Discord, and let's just chat about the financial markets. Let's chat about moving ourselves financially forward as we navigate this life of ours. I am Dr. Stock, Doctor of Education. Remember, learning is earning.